Hey everybody, it's John King with Summit Funding. It is Friday, the 28th of April, and here I am with my weekly market update and miscellaneous things that I want to talk about today. So what am I going to cover? The first thing I'm going to talk about is an update on the banking crisis, what's happened with banks like First Republic and Silicon Valley Bank, and what I think that's going to mean to the future of banking and lending. The second thing I want to talk about is what to expect from the Fed meeting next week. They're getting together next week on Tuesday and Wednesday, the 2nd and 3rd, and what do I think is going to come from that? I'm going to talk about how to avoid paying any of the loan fees that have been in the media for the last couple of weeks. You've heard me have videos about this on Biden's supposed charging of higher fees to higher credit score buyers. Well, guess what? There's an option to not pay any of those fees while getting a conventional loan for certain people that make under certain income limits, and I'll cover that. I'm also going to talk about the 15% down payment hack that just went away. And then I'm going to talk a little bit about what's going on with CalHFA right now and an update on their assistance programs. We'll talk about a brand new assistance program called the WISH program and explain to you a little bit about what that is. And I'm going to end with a little bit about my How to Buy Masterclass. So let's go ahead and dive in. The banking crisis is not over with. We've got major issues going on right now. First Republic Bank just this week had their quarterly earnings, and they announced publicly a lot of information about what happened when Silicon Valley Bank collapsed and First Republic was really on the verge of collapsing. And it was really bad, and it is still really bad. They're in tough conditions. The Federal Reserve just came out today, right before I recorded this video, and the Federal Reserve said, look, we screwed up. Like, we did not oversee them well enough. We dropped the ball in not paying attention to the challenges that we saw right in front of us. I think that's a good thing because the Fed is now at least recognizing, hey, we made a mistake. But here's the deal. Oftentimes, just like what happened in the 2008 financial crisis, where they said, oops, we messed up, the fix is going way too far the other direction. They tighten things way too much as a reaction. We all do it. It's human nature. So my concern is what's next? What is the Fed going to over-tighten from a banking perspective? And this could have to do with how much money they have to keep in reserves, how they value mortgage investments. Right now, this week, we've had a significant amount of mortgages, old mortgages that were owned by Silicon Valley Bank, that the Federal Reserve has now taken over Silicon Valley Bank, and they have to sell those assets. And that's driving the market, and interest rates are climbing right now. And part of it is because there's a huge supply of mortgage debt being pushed into the market. And I think if the regulators come in and the Fed says, look, you guys need to change how you invest in mortgages, not because mortgages are bad, but simply because the underlying value of that mortgage isn't worth as much because rates have gone up. Therefore, they're going to have to change how they view the mortgages they're holding on their portfolio and how they view new mortgages. I see and feel the jumbo world tightening. I don't believe we're going to have as loose guidelines as we did in jumbo, and they weren't loose already, but we're going to see that tightening, and that really, to me, is the next shoe to drop in the banking crisis that's unfolding right now. Now, next week, the Fed is meeting on Tuesday the 2nd and Wednesday the 3rd. They're going to be announcing whether they're going to raise rates. There's a lot of speculation about whether rates are going up or not. The fact is, I think there's a good chance rates are going up by a quarter. I think there's a small chance rates don't go up at all. I think this is likely the last time the Fed raises interest rates. The Fed has been on an upward tear of interest rates, and the old adage says the Fed will raise rates until something breaks. Well, something broke. They broke the banking system. And back in March, it was pretty clear that the Fed was likely to slow down or stop their rate increases. And then earlier this month in April, and we had some positive economic news regarding unemployment data, and the Fed started worrying, and the market started worrying, hey, the Fed might keep raising rates because they want to see more unemployment. That's kind of demented, but it's the truth. They want to see more unemployment because as unemployment goes up, it means people have less money to spend on other things, on just household goods. Well, that's what inflation is. The more people spend on buying things, the higher prices go. And so the Fed is trying to drive prices down. Let me summarize this very simply by saying, I think that we are hitting the peak of interest rates. I had a conversation with a client just recently about, hey, should I take out a home equity line of credit with a variable interest rate? And my answer is, look, interest rates are pretty much at their peak. So we're going to see rates start coming back down. Now is the time, if you're needing to take out money, it's a good idea to consider a variable rate, because when you get a fixed rate, you're typically paying more than the variable rate. And guess what? The fixed rate doesn't come down as the rates come down, but the variable rate does. Now, it's about how long you need the money, because I think in the next 10 years, we're going to see a swing back up in rates. And so should you take a long-term approach and say, well, gosh, I want a variable rate even though I think I need this money for a long amount of time? No, that's a bad idea. But if you think you're going to be able to pay back the money within the next 5 years, a variable rate today isn't a bad idea for a home equity loan or line of credit. I still don't think it's worth it for your mortgage, because in a mortgage, you're not saving anywhere near as much money when it comes to the difference between a fixed rate mortgage and a variable rate mortgage. And so therefore, I don't believe that's a worthwhile trade-off. Okay. All right. There has been so much talk over the last couple of weeks about the increase in fees for high credit borrowers. I've got some great videos that I've done. I've got one short one about 5 minutes. I got another one that's almost 30 minutes long that goes into detail about what I think is happening and why. So check out those videos. You can see the links down below for both of those videos. I like the long one. I think it goes into more detail. I give you a lot more opinion about what I think is happening and why. But here's the deal. There's a way to avoid all of that. It's called our Affordable Advantage program. The Affordable Advantage program says, look, if you're a first-time home buyer and you make less than a certain income amount, now depending upon the county you're in, will drive the income threshold, and sometimes it's up to 100% of the area average income. Sometimes we can stretch it up to 120% if it's considered a high-cost county. But if you're in that income bracket, you actually get to avoid paying any of those fees. And it really makes it a really, really good deal for you. Even if you have lower credit, whether you have higher credit, it doesn't matter. You get to avoid any of those adjustments. That colorful chart that we've seen all over the news and social media goes away. Everybody gets exactly the same deal if you're a first-time home buyer and you're under certain income limits. So reach out to me so I can explain it, because most lenders don't understand it, and they have to opt you into that program. It's not automatic. So if your lender doesn't understand that, you're going to pay those fees that you don't need to pay if you're under a certain income threshold. So reach out to me so I can help you understand that. One of the other things that's happening recently with that change with loan level price adjustments is a sweet spot that used to exist was just eliminated, a loophole, a cheat code, whatever you want to call it. And that was, I use this loophole all the time. And that was when you put 15% down, you got a better interest rate than when you put 20% down. Now, the logic for me was simple, which is, at 20% down, Fannie Mae is taking 100% of the risk. At 15% down, Fannie Mae was not. They had a partner in the mortgage insurance company. But it meant that I could actually give you a better interest rate if you put 19% down than if you put 20% down. And you could have bought out of the mortgage insurance for a pretty cheap fee. So it made it a better deal to put 19% down or 15% down compared to 20. Well, that loophole went away. They basically said, no, we're not going to give you a discount. And so that's a piece that, if you've heard me talk about that before, that hack, that loophole, it's gone. So just be aware of that fact. CalHFA is really dealing with a major issue right now of all of the people that have locked their Dream for All loans. We're now officially about 5 weeks after that program launched, and the rate locks are 30-day rate locks, which means we've got a lot of people who locked in their interest rate that had to close within 30 days, and they couldn't get their file submitted to CalHFA because they didn't have their counseling done. I had a client last week register for counseling, and their date was August. Okay, it is broken. It is really backed up. Now, CalHFA's created, they've done as good as I can expect them to do. They've created opportunities to get your counseling date moved up. They've helped people to solve that challenge, but now they're dealing with the pipeline of 2,500 families who have locked a loan that they have to process every single one of those. And they have historically been able to process 30, 40 a day, which meant that was like 3 months worth of loans to process. Now they're working weekends, they're working late nights, they're putting in a significant amount of overtime. They're making progress, but it's rough. There are clients that are going to risk closing late. It is nowhere near as bad as what I was afraid of 30 days ago. I commend CalHFA. They've done an amazing job of catching up and dealing with the issue, but they're still running at least a week behind from when we submit to when we get approval, and that bubble's getting bigger right now, and we're up against that 30-day rate lock. So that's something to be aware of. But the fact is, I want to publicly say I think CalHFA has done an amazing job, way better than I thought they would, in how to manage through this. And hopefully they're learning from it on what they should do different next time when they launch the Dream for All program again. Speaking of new programs, I want to talk to you about the WISH program. I'm actually doing a live stream today. By the time you watch this, I will have done the live stream about the WISH program. The WISH program is absolutely amazing, but it's super specific on who qualifies for it. And so I want you to check out that video because I go into a lot of detail. It's a grant that is completely forgiven after 5 years. If you keep the home as your primary residence for 5 years, up to $30,000 regardless of your purchase price. And it's based on income limits that have tiering based on family size. Most other down payment assistance programs, the income limits don't care how big your family is. This one cares. And it looks at it saying, hey, if you're a family of 1, you got a lot lower income limits. You're a family of 8, you've got a lot higher income limits to still qualify. And there's some cool loopholes that we can utilize on this. So check out that video. The link will be down below as well so that you can really get good information about how the WISH program may help you, or if you're industry realtor, then this may help a lot of your clients as well. The final thing I want to talk about, my How to Buy Masterclass. So I do these masterclasses once a month. I just did my April masterclass last night. I spent a good hour talking about what's happening in the market right now and why, who should be buying and who shouldn't be buying in today's market. But then I also went deep into a new topic of how to pick your real estate agent, what to look for in a realtor, what things to expect from your realtor, myths about working with real estate agents, and really helping you understand the relationship with your real estate agent. And the second new thing that I added last night into my masterclass was an idea of how much money do you have to spend at different stages in the home buying process. When do I pay for this? When do I pay for that? When do I pay for this? And what inspections do I need and who pays for those and how is that handled? So a lot of information that I'm providing. Each of my monthly masterclasses are on a different topic. They're all covering how to buy in general, but I try and focus on something new on each of them. And so that's the new information that I'm providing for this month's masterclass. So please check it out. The link for that is also down below. If you haven't already subscribed to my channel, please like it. Like this video, put a comment if you have any questions or thoughts, and subscribe to my channel and click the notification bell. I really appreciate you, and I hope you have a wonderful weekend. Talk to you soon.